In today's video, we will understand why zero-hero trades happen on the expiry day of options, what role Gamma Blast plays in this, and finally how we can identify zero-hero trades. At present, there is some form of expiry on every trading day of the week in the market. However, it is expected that with SEBI's upcoming rule, the total number of expiries may be reduced to 2. Because every day now marks an expiry, many retail traders with limited funds search for zero-hero trades on the chart to turn small capital into big gains. But only a handful succeed, while the majority end up in losses. What's more, both the traders who book profits and those who lose money usually lack clarity on how an option premium suddenly jumps from $10 to $100 within a short period on the expiry day, or what exactly causes this. As a result, many participants treat this purely as gambling. In trading terms, such setups are called zero-hero trades. That is why in today's session we will explore the reason behind the sudden spike in an options premium. Let's begin, but before moving forward, if you find this content useful, hit the like button, and if you are new here, don't forget to subscribe and turn on notifications so you never miss our uploads. We'll meet you right after the intro and disclaimer. Welcome back, traders. Let's discuss this. First, we need to understand the delta and gamma of an option. These Greeks must be clear. Suppose the spot price of Nifty 50 is 25,000 at the moment, and the delta of the call option at the same strike price is 0.50. If Nifty then rises by 100 points to 25,100, the premium of this call option will move up by 100 * delta value, meaning it will rise by 50 points in the market. If you have carefully tracked the option chain, you will notice that the delta of out-of-the-money options usually stays between 0.00 and 0.50. The delta of at-the-money options is about 0.50, while the delta of in-the-money options lies between 0.50 and 1. The delta of call options is always positive, whereas the delta of put options is always negative. But is delta fixed permanently? The answer is no, because delta changes with time. To understand this, we must look at gamma. If the spot price of Nifty 50 is 25,000, then the premium of this call option will move up by 100 * delta. That is, by 50 points. Now, with a 100-point shift and delta at 0.50, suppose the gamma of this strike is 0.008. If Nifty increases by 100 points, then the gamma effect will add up. In this way, gamma rises, and as gamma increases, delta also moves higher, which in turn pushes the option premium up as well. If these calculations seem confusing, let me simplify. Here, Nifty rises 100 points. So multiply 100 by the gamma value. The result is 0.08. Add this to delta, and the value rises from 0.50 to 0.58. Now apply this delta to the option premium. Along with this, vega and theta also impact the movement of option premiums. But in my view, you don't need to manually calculate these during live trading. As an options trader, simply focusing on the graph itself is enough to get the job done. In any trading instrument, the gamma of out-of-the-money options remains low, while the gamma of at-the-money options is the highest. Similarly, the gamma of deep-in-the-money options starts to decline. This means that as the price moves away from at-the-money, its gamma gradually decreases. Time also plays a crucial role in reducing gamma. On the other hand, as the price moves deeper into the money, the delta of options continues to rise. Now let's understand how a gamma blast occurs on expiry day. On the expiry day, the gamma chart looks like this. Suppose it is close to 2 o'clock in the market, and we are tracking the call option of 25,000 on Nifty 50. As the market slowly approaches the 25,000 level, both the delta and gamma values begin to rise. But the moment the price exactly hits 25,000, our call option turns at the money. Since at the money options carry the highest gamma, as soon as this option becomes at the money, its gamma suddenly shoots up, which makes delta climb rapidly as well, and the option premium surges at the same speed. Because of this, gamma rises so aggressively that it becomes very difficult to capture, which in trading terms is called a gamma blast. This is why we witness sharp spikes on the option premium chart during the final hours of expiry. The premium that was trading at $1 can suddenly jump to $10 or even higher. For this reason, Gamma Blast is often termed zero hero trade. But as soon as the price moves slightly in the money, Gamma starts dropping again, which raises the risk. The option premium begins falling quickly, and the candles of the premium chart start pulling down after hitting a peak, creating long upper wicks. This happens because while delta remains steady, the sudden fall in Gamma drags the option premium downward. Hence, on expiry day, if you enter at such inflated premiums, you end up with losses as the premium falls rapidly. Therefore, you should avoid buying options at such elevated levels. It is better to wait and enter only after the premium stabilizes once the Gamma effect subsides. Now, how can you catch this Gamma Blast in advance? Let's understand. Suppose you have the Nifty 50 chart in front of you, and after analysis you believe the market is likely to move upward from this point, and the time is 1 p.m. The price on the chart is trading near these levels, and we decide to buy the call option here based on our view of the market going higher. At this stage, the 25,000 strike is at the money, within the money options below and out of the money options above. As we move away from at the money, we move into deep in the money and deep out of the money strikes. Based on our analysis that the market may break 25,000 and move higher, we go 50 points above 25,000 and select a slightly out of the money option, namely the 25,050 call option, because its premium is low, requiring less capital. Also, since the Gamma of this option is currently low, if the market moves above 25,050 as per our analysis, then with the rise in Gamma the delta of our option will increase sharply, and the option premium will also rise quickly, allowing us to capture the Gamma Blast and book a solid profit. However, I caution you not to risk your full capital on such setups because the win rate in zero hero trades is very low, and you could lose your entire amount in one session. Furthermore, although out-of-the-money premiums are cheaper, avoid buying deep out-of-the-money options because they mostly carry only time value, or theta, and if the market turns sideways even briefly, your premium has a high chance of decaying to zero. That's all for today, traders. Thank you for watching this video. I hope you gained real value from this video. If you did, make sure to hit that like button. It truly supports the channel and shows us you're enjoying the content. And if you're new here, don't forget to subscribe for more trading strategies. Thanks for watching, stay disciplined, stay consistent, and I'll catch you in the next episode.